If you're losing money with a $10,000 account, but somehow making better decisions with a $100 account, the problem isn't your strategy, it's your psychology. And most traders never realize this. They think a bigger account will solve their problems. More capital, more opportunities, more profits. But what usually happens? The account gets larger, the mistakes get larger, and the losses get larger. Because money doesn't create discipline, it reveals the lack of it. That's why some traders can grow a small account consistently, while others destroy large accounts over and over again. And once you understand why this happens, you'll start seeing your own behavior differently. Because the real battle in trading isn't between you and the market, it's between you and yourself. When most traders start with a $100 account, something interesting happens. They become careful. Every trade matters. Every mistake feels expensive. They suddenly start following rules. They wait for setups. They manage risk. They become patient. Not because they discovered discipline, because they know they can't afford to be careless. Now, compare that to what happens when someone deposits $10,000. Suddenly, confidence appears. But it's not real confidence. It's account size confidence, a very dangerous difference. Position sizes increase, rules become flexible, risk management becomes optional, and the trader starts believing the account can absorb mistakes. This is where psychology begins to quietly sabotage performance. You think you're trading differently because you have more capital. In reality, you're behaving differently because your relationship with money has changed. And that changes everything. Here's a pattern you've probably experienced. You take a trade. It moves against you. Your stop loss gets close. Instead of accepting the loss, you move the stop. Just a little. Then a little more. Then a little more. At first, it feels logical. You're giving the trade room to breathe. But deep down, something else is happening. You're trying to avoid emotional discomfort. The market isn't the problem. Being wrong is. And larger accounts magnify this problem. Because now every loss feels bigger. Not just financially, emotionally. The strange part is that most traders think they need more discipline, but discipline is often the result, not the cause. The real issue is emotional pressure. A trader risking $1 feels one thing. A trader risking $500 feels something completely different. The chart is identical. The setup is identical. But the emotional experience is completely different. And trading decisions are made inside that emotional experience. This is why professional traders obsess over risk, not because they're afraid, because they understand something amateurs don't. Your ability to think clearly disappears when the risk becomes emotionally significant. Read that again. Your strategy doesn't stop working when your account grows. Your decision-making does. That's a massive difference. Professional traders understand that consistency comes from protecting mental clarity. Amateurs focus on maximizing profits. Professionals focus on minimizing emotional interference. And that's why one survives while the other keeps restarting. Now let's look at another hidden trap. When traders have small accounts, they usually think long-term. They know doubling $100 won't change their life overnight. So they focus on learning, improving, building habits. But give that same trader a larger account and a dangerous thought appears. This could change everything. Suddenly, every trade carries extra meaning. Every win feels important. Every loss feels personal. The trader stops trading probabilities and starts trading hope. Hope is one of the most expensive emotions in trading. Because hope convinces you to hold losers. Hope convinces you to ignore risk. Hope convinces you that this trade is different. Professional traders don't trade hope. They trade process. That's a critical distinction. Here's a simple framework you can start using immediately. Before entering any trade, ask yourself one question. If this trade loses, will I still feel emotionally neutral? Most traders never ask this, but the answer reveals everything. If the loss feels emotionally painful, you're probably risking too much. If the loss feels threatening, you're definitely risking too much. And if you're risking too much, your brain will eventually interfere. Not because you're weak, because you're human. This is where many traders misunderstand confidence. They believe confidence comes from winning, It doesn't. Winning creates temporary confidence. Real confidence comes from knowing you can follow your process regardless of outcome. Those are very different things. A trader who wins 10 trades through bad decisions becomes fragile. A trader who follows rules through 10 losses becomes strong. One is building ego. The other is building resilience. The market eventually exposes the difference, and it always does. Here's something that surprises many traders. The goal isn't to trade a $10,000 account like it's a $10,000 account. The goal is to trade a $10,000 account exactly like you traded the $100 account when you were at your best. Think about that. Back when you were careful, patient, selective, focused on execution, not money. That's the mindset that creates consistency, not the account balance. The balance is just a number. The psychology attached to it is what matters. And this leads to one of the most important realizations in trading. Your account size doesn't determine your results. It determines how much of your psychology gets exposed. Small accounts hide weaknesses. Large accounts magnify them. Fear becomes larger. Greed becomes larger. Impatience becomes larger. Ego becomes larger. The market simply turns up the volume. That's why some traders look brilliant on demo accounts and completely fall apart with real money. The strategy didn't change. The emotions did. And emotions always influence decisions unless they're managed intentionally. So the practical takeaway is simple. Trade smaller than your ego wants. Risk less than your excitement suggests. And focus more on process than profit. Because the trader who can remain emotionally stable with $10,000 is the same trader who learned emotional stability with $100. The account didn't create the skill. The account revealed it. And that's the lesson most traders spend years learning the hard way. The market was never asking how much money you had. It was asking whether you could think clearly when that money started to matter.